This is Dan Sheridan. I'm excited to be chatting with you today. We're going to go over a few strategies, and just want to give you a heads up. Next week, we'll be launching our new October 3K class, a plan to make 3K a month on 25K. And a lot of it's based on turnover. You know, we're putting on 15 to 30-day trades and generally taking them off within a week. So on the same capital, you're able to turn the inventory over 3 or 4 times, which is very effective. What's nice is we've been doing this 3K class, been very popular since a year ago, June. So whatever that is, 16 months or more, because we stress the risk management and many other things. We basically, in this downturn and volatile market, we've had maybe 5 months where we're close to break even, and then maybe 12 months or so of making money. Pretty on, you know, pretty close to the projected yields, which are, you know, 3% on your trades on a weekly basis, 12% monthly. I'm going to go over a little bit of our process today for a few minutes, but you can get information on Sheridan Mentoring on that. We start next week for the October 3K. What's neat about it is you're going to learn a ton in these 4-week, every month we'll go for 4 weeks, twice a week for an hour. But what's great is we're trading together. We're taking you by the hand. We're doing this, exactly what we're talking about. We're doing it. We're showing you how much capital we would allot. And the capital's been lower. The yields have been on target. Capital's been lower because of the market. So generally what I start with, I'll just give you a quick rundown of how we do things. You know, we start with the process. We'll look at, we're doing range bound trades, even though we do spec trades and stuff also, but the core would be range bound. You need some type of range. So we'll look at, you know, what affects your option strategies the most. It's price and volatility. So we'll say, okay, we'll look at, are we, you know, trending or range bound? Well, if you look at the market today, SEP 29, you know, we're down 60 points. Then you look at the last 3 weeks or so, you know, straight down. So that's not conducive to range bound trading. You look at the ATR, which takes the difference in the high and the low in SPX or any vehicle, and the wider the range, it's going to be more turbulent. Narrower the range for range bound traders, and right now it's trending up. So that's a no. Then you look at today. Well, today's already moved 1.67%. So that's not usually a day that I would do much, right? So we'd say no. And then moving averages, we really, you know, whether it be the 500 or the 200-day moving average, the 50 or any short term, we really haven't clearly bottomed. So we're not going to get any you know, until we go up some and get some two-way, we're not going to be that interested. So that would be a no, right? So 4 of the 5 criteria have to do with price. The last one has to do with volatility. You know, are we in the 6 to 7 week range? What's the range in VIX? It's been 20 to 28. And right now we're at like 30, almost 32. So it's outside of that range. That would be no, you know. So in this environment, what would we do? Well, we would do smaller size, further duration, and in the 3K class, which again, we're going to be doing exactly what I'm talking about today, next week. When you look at allocation of capital, you know, generally in the class, what we're doing, it's 3K on 25, right? And so out of that, we're leaving 5 grand, which would be 20% in cash for opportunities or adjustments or whatever we need. So on Tuesday, with Tuesday's class, we're allocating 10 grand of trades, usually 1 or 2 trades. And on Thursdays, we'll allocate 10 grand. Now, most of the last 2-3 months, we've been doing 30–40% of the capital. Why? Big candles, one-way movement, it's just not range bound. It's like you go into the ocean, you say, hey, I spent all this money, I'm at the beach with my kids, I'm jumping in. Well, what if there's sharks or lightning or high waves? I'm doing it anyways. No, you're not. So that's why over the last 15 months, and most of it being pretty volatile, we really haven't had any major problems in terms of down, the account being down or for that particular month, because we are more picky. And, if it looks like massive turbulence, you don't have to play. All right. So that being said, if you look at today, obviously, I go a little bit more duration. Our duration is normally 2 weeks to 5 weeks, smaller. And then capital, if today were a Tuesday or Thursday, which it's Thursday, but this is a week off from the 3K, we start next Tuesday, I'd probably be looking about 30% of the capital. Why? We just went over it, right? Too much turbulence, right? Are you going to fly into Hurricane Iona? I don't think so. All right, so a couple things we're looking at, and these would be things, maybe opportunities I would be looking during the class when we start up on Tuesday. First thing, one trade, excuse me, there's many different types of butterflies, different flavors of them. But in terms of a downtrend, there's no range bound trade that works better than a balanced butterfly. And here we have, we're at 36.50. So I put the short, sell to it at the money, and then go 70 points in the money and buy a 35.80 call, the Oct 21 expiration, then go 70 points out of the money and buy a 37.20 call. And what you can see, if you look at the graph, I want to show you something neat. This is think or swim. So the expiration graph is in blue. That's in like 25 days, the Oct 21 expiration. The purple line is today's graph. So you're looking at the purple, today's graph, we can go down to 34, literally 34.80, which would be 170 points from where we're at now. We don't lose a penny, right? And this is on a relatively neutral, to me, our deltas are minus 0.95 with this. And I think in SPX, if I'm plus or minus a delta, that's relatively neutral. And we'll talk about, excuse me, let me drink some water, on the upside, how we would adjust it. But this is what we've done a lot of these balanced butterflies on the downside. But we also show you if we go unbalanced and make it more neutral, which I probably would do on a day like today. I wouldn't enter balanced because we're already down. I would go a little bit unbalanced. So that's one thing. The other thing, obviously, iron condors might go a little bit further out expiration. Here's October 28. And you can see what's nice about doing iron condors in a high volatility environment. You get a higher credit, but you get a lot more room from your short strikes to the current price. So right now we're at 36.50. 30-day out iron condor, I can get 39.40 on the upside, about 300 points, and on the downside 33.80, which is close to 300. So that's another thing we'll talk about next week. And then for those of you who like credit spreads, I mean, these are opportunities I've seen in the market now, but again, much less size because of the turbulence. There's a put credit spread, but similar. I like about put credit spreads is, if you look at one, a 10 wide put credit spread in SPX, I mean, you're less than a delta long. So your risk on the downside is more manageable than other type trades like vertical debit spreads or whatever. Now, one last thing I'll talk about that I'll probably talk about next week, when the market's down, what might you consider in, let's say somebody for the long part of the portfolio, let's look at. So the last three trades were quickly talking about your range bound trades, but let's look at an example in Apple. Maybe got rid of that. But I'd be looking at Apple because the volatilities are higher. If you look at volatilities here, look at this, the implied volatilities are higher because the stock's been cratering down, right? So I would look at, first of all, for people who do covered rights, in stocks they like, I would go instead of long stock, buy an in the money call, but I'd do a diagonal, and I'll show you an example. I'd go out maybe on my longs, go out to D16, right? That's 78 days out. And then on my shorts, with D16, I'd probably buy something maybe like around a, 79 delta or something. So I'd buy the in the money 125 calls, D16. And then against it, what I would do, so that's my stock surrogate. Instead of buying stock, I'd buy in the money call. It's much cheaper. So then if I go in the money, go closer in and maybe sell a OC20, OC28 call, something like that. So I could sell an OC28, but what I do, because the volatilities are higher, I can go in, if I want to be more conservative, I can sell an in the money call, like the 140 call. And I want to show you something neat. And if you look at the graph there, it's like, wow, I have less exposure. I'm leaning much less long deltas than a covered right type trade. So my break even on the downside on this trade over the next month is about 134 an apple, right? Which is about $10 down from where it is today. And it's down 7. So these are some things I'm going to talk about next week. But what's great is you're going to get that combo. Hey, I'm going to learn. We're going to do it together. So we're not just going to talk about fettuccine Alfredo. We're going to make it. So we'll see you next week. We start off, check out Sheridan Mentoring on the webpage, and we'll see you then. Thanks.